I believe that once we get into 2023, the Fed is going to slap their head and say, by golly, Bill Conerly was right. Our work is not done. We have to keep raising interest rates. And I think they're going to keep pushing interest rates up over the course of 2023.
Move over, baby boomers. It's time for Gen XYZ. It's time to stop waiting on the world to change. It's time to be the change. It's time to stop thinking about how your life can be better. It's time to start taking action, massive action to improve your life. Join Zach Winter and Markadair Rios every week as we learn how others had the grit, determination, and conviction to 10x their lives, and as we explore ways that can help you 10x your life.
Hi, everyone, and welcome to another edition of the 10X for Gen XYZ podcast. I'm Zach Winter.
And I'm Markadair Rios.
And today as our guest, we're pleased to have Dr. Bill Conerly. He's an economist. He connects the dots between the economy and businesses. He has a unique combination of a Ph.D. in economics from Duke University and over 30 years of experience helping companies adapt to changing economic conditions. He was formerly a senior vice president at a major bank, and he's held positions in economics and corporate planning at 2 Fortune 500 companies. Bill, welcome to the show.
Great to be here, guys.
I want to open it up by just starting to talk about where we are with the economy. We're recording this on June 16th. Yesterday, the Fed announced plans to hike its policy rate another 75 basis points, lifting rates across our economy again, including home and commercial real estate mortgage rates, credit card APYs, corporate borrowing rates. Before this announcement, the Michigan Consumer Sentiment came out at 50 for the month of June. That's the lowest record on track stretching back decades. For comparison, it was at an 85 a year ago. The S&P and NASDAQ have now kind of officially fallen into bear territory, declining more than 20% from their highs. And the CPI index rose to 8.6% in May from a year ago, the highest increase since December 1981. So are we in a recession?
After all of that data, I'm wondering if anybody is still paying attention or if they've jumped off cliffs.
Right.
Anyway, as for are we in a recession? No, not yet. Usually when people ask me if there's going to be a recession, I say yes. And then I try to change the subject before they can get around to asking when.
But do you think just real quick on that, do you think that it's a little bit too late to hit that proverbial soft landing that everybody's been talking about?
It's probably too late. I would say maybe 90% chance that a recession will come out of the inflation fighting effort, but I don't think the recession is right around the corner. I think there's a lot of stimulus that's still in the system.
So the definition of a recession is 2 consecutive quarters of negative GDP. Is that right?
That's a rough approximation to the official definition. And the official definition is there's a committee of mystics who sit around and talk, and they look at the data sometimes years later. And what they are looking at is, is this a recession? Or if we had another downturn, would that be part of the recession? Or if it suddenly started going up, would we say that? So they're not trying to call it in real time. They're providing a service for future generations of economic researchers.
So they're basically looking in the rearview mirror and saying, yes, we likely entered a recession back on this date.
Exactly.
But your view is we're not there yet. And it may be a while until we get there because there's still some stimulus in the economy.
Exactly, Zach. I think that it'll take a while to work through all the stimulus that's in our system. And so we'll continue to have inflation despite what the Fed did, on June 15th.
Would you just as an add-on to that, would you say that like consumer sentiment kind of adds to this recessionary overhang of feeling as well? Like we can go into recession ourselves and kind of force the situation, correct?
No, I don't think so. I look at the consumer sentiment data just because I look at everything. Usually it is a result of other factors. And the big three that tend to move it are unemployment, inflation, and interest rates. So unemployment is still very low, but people have been looking at accelerating inflation, rising interest rates, and then there are sometimes a bunch of other stuff. And it's the other stuff that I use the consumer sentiment for. If there's a war, like when we did the Gulf War, or the Ukraine war, or the prospect of further war, COVID is something where you want to look at consumer sentiment, but you have to keep in mind most of consumer sentiment is a result of economic factors.
Okay, that's good to know. It's very good to know.
What do you think the Fed is likely to do? You indicated that there's still stimulus going through the system, indicating that that may continue to drive prices up. And so I take it you think the Fed's going to continue to raise interest rates then to try to curb inflation.
Yeah. And I'm a little bit different from my fellow economists in this. We all tend to agree that there's going to be more short-term rate hikes in 2022. The Fed says so. I agree with them. Their target for the end of this year is short-term rates at, I think it's 3.4%, something like that. And I think that makes sense. They think then that their work will be done. And I believe that once we get into 2023, the Fed is going to slap their head and say, by golly, Bill Conerly was right. For a change, our work is not done. We have to keep raising interest rates. And I think they're going to keep pushing interest rates up over the course of 2023. And that's what it's going to take to get inflation down. So I don't worry, because of all the stimulus, I don't worry about a recession over the next 12 months. But the second half of 23, things get dicey. 2024, things get very, very risky.
How much do you think the Fed can continue to raise interest rates given our national debt level is now over $30 trillion? And, the Congressional Budget Office, even before they raised rates yesterday, were projecting that our national debt would reach $399 billion, our interest payments this year. Over the next 10 years, soaring from $442 billion to, I think, $1.2 trillion. And it's going to exceed any other government program, exceed defense spending, Medicare, Social Security. How much can they continue to push interest rates given their debt payments they have to make?
Zach, you sound like somebody who does not live in Washington, D.C. We've been talking about Build Back Better, or which I think of as Build Back Great Again. We've been talking about infrastructure. There's nobody in Washington, D.C. who seems to worry about the deficit.
There really isn't. I mean, even given where we are now with inflation, the Biden administration is talking about student debt relief, which again is going to.
So I think the Fed will ignore the question of what is the interest expense to the U.S. Treasury. It's just another element on the of the deficit, and I think they'll do kicking and screaming. They'll do what needs to get done.
This is pretty. I mean, this is pretty much like we're fully into, at least in Washington, fully into modern monetary theory, right? Just fully into this idea that deficits don't matter. That old audio clip of Dick Cheney basically saying that years ago. Yeah. I mean, I think everybody's leaned into that in Washington, just like, yeah, he's right.
We are running an interesting experiment. Yeah. And this modern monetary theory, which I think of as nonsense, is a test of the hypothesis that you can just spend money, have the Fed print it so the government can spend it without any consequences. We're testing that hypothesis, and the Bureau of Labor Statistics said last week 8.6% inflation is what you get from that theory.
But is there a counter is there a counteracting force, I guess, within that theory that's basically saying if you grow the GDP alongside that, you can kind of counteract those forces? Is that?
Yeah. So let's do a business analogy here. I don't mind a company borrowing more every year, so long as the value of the enterprise is going up, so long as their revenue is going up, they're growing their top line faster than their debt. We're all happy with that kind of story. But you cannot have the kind of spending that we had, especially the last couple of years since the pandemic, forever. That just absolutely is a formula for disaster.
Yeah, totally.
I don't know if you've seen the chart of the yen, the Japanese yen, but it's insane. I mean, I think they're at the forefront of modern monetary theory, and they've been debasing their currency. It really looks like they're on the precipice. And I just wonder what the ramifications of that are, whether that could cause a cascading effect to the global economy, and whether that's foreshadowing what we could be looking at if we just continue to print money.
Well, let me tell you what we have seen when we look at other countries. We haven't seen a country as big as Japan get into trouble. But, Italy is pretty big, and they got sort of close to trouble, and Greece, of course. But what we've seen in the Mexican debt crisis, the Russian debt crisis, other Latin American and African countries, is everything looks fine until it doesn't. Like week after week, their treasury is doing auctions of bonds and treasury bills, and everything goes fine. And then one week, a couple of the major players, investment banks, say, let's just sit out this treasury auction. And the next week, nobody is there. As a young economist, I expected people to gradually demand higher interest rates if they were going to buy the bonds of these countries that were borrowing too much, and that you'd see a gradual change. But you don't see it, a gradual change. You just see everything is fine, and suddenly it's not. So I rub my chin and I wonder, when is the U.S. suddenly going to be not fine?
Right.
But, we tend to see our own faults more clearly than other people see them. I don't know if you guys are like that. Most humans are. The one thing I'll say about Donald Trump is that he overcame that problem of seeing his own faults better than other people see them. But when we look at the problems that the United States has with our huge deficit, irresponsible policies in Washington, D.C., we tend to think, why would anybody want to buy U.S. debt? But the global investor says, where do I put my money? Should I buy the debt of the United States, or the debt of China, or the debt of Romania, or, where do I put my money?
Makes a lot of sense.
One person said, the U.S. is the best looking nag at the glue factory.
And we keep on riding that nag in our off time.
And we'll be fine until suddenly we're not.
That's interesting. Speaking of Japan, I did want to ask you about this. So I saw it was actually a LinkedIn post conversation that we were having, but there was a chart about the Fed funds rate, and it was kind of showing, the ups and downs since the 1960s until now. And it was from the Fred website. Anybody can look it up. But we were kind of asked this question: do you see the trend here? And people were looking at how, there's a dip before the recessions hit and things like that. But the thing that I noticed was, if you smoothed out the curve, you could see the Fed fund rate basically on a downhill trend since the Volcker days, right? Since the 1980s. And even with the dips in the kind of increases, we were always completely on a downtrend, to the point of from 2010 to about 2018, I think it was, we were probably sub one, right around one. It went up a little bit. And then in 2019, I believe it started going back down again, right? When everybody was worried about their 401ks and they started slashing rates. And then of course, COVID hit. I don't know if this is a thesis, but what I did notice was it feels like the longer that we stay down here, we don't have any room. Like you said, Zach, we don't have any room to go kind of really, really high. And so I'm kind of happy for the more they increase rates, even though it hurts, because that means that if we have to cut again, there's going to be some slack in the system, right? Because if we stay too close to zero, we're stuck in that Japanese liquidity trap, as they call it, right?
Yeah. But I think, though, that quantitative easing can be powerful. So even if interest rates are low, if the Federal Reserve just pushes a lot of money into the system, they can stimulate the economy. Now, when they did that in 2008, banks ended up with more reserves and they just sat on them. They did not lend them out, but the Fed was paying interest. I think that monetary policy is still powerful, even if we're at what they call the zero bound, where interest rates can't go below zero. Although they did.
Has Japan been buying their own bonds? Have they been doing QE? Or
I haven't gone into Japan's information in detail.
They've been trying to, at least from what I've read. I mean, the central bank has been trying to keep it at 0.25, and it's right at the precipice, and they just keep buying and buying and buying. But it's becoming very difficult for them.
Well, Japan illustrates a couple of things.
Yeah.
One is a challenge of an aging population, without a doubt.
Yes.
An aging population and a culture that says we do not want immigrants, and that has limited their growth. And then a political culture that says we need to protect all established businesses. And they do not believe in creative destruction. They do not believe in letting the big old companies fail and having new ones develop. They had some great new companies develop, Honda, Toyota, Sony. After World War II, they did some great things, but what they've done in the last couple of decades is try to protect their dinosaurs. And protecting your dinosaurs is a formula for your country becoming a dinosaur.
That's you bring up some really good points there. Like the thought flashed in my mind too, that, their empire building pre-World War II or World War II, effectively they were working on trying to expand their base to kind of help grow, right? Which is what empires do.
Yeah.
And by being curtailed naturally or unnaturally by their own design in a lot of ways, but also by the world kind of containing them after the war, they're just kind of stuck on the island, right? Yeah. They can't grow.
Yeah.
Now they're starting to flex. We're hearing about, they're kind of starting to want to flex a little bit. Just a little bit, especially in response to what's going on with China right now.
Hey, Bill, so your thought is the Fed's going to continue to raise rates this year, and they'll be forced to do so next year because inflation will still be running hot. And it sounds like you think we're doing okay with unemployment being relatively low. I'm starting to see articles about layoffs picking up, large corporations laying people off. Do you think what's the risk of stagflation hitting, where we have higher unemployment but also higher interest rates?
Very high risk, and it has to do with the time lags. So when the Federal Reserve does something, whether they're trying to goose the economy forward or slow it down as they are now, it takes time. Mm-hmm. And the time lag to affect inflation averages just under 2 years. And it's actually a distributed lag, but you can simplify it as they do something and 2 years later, you see an effect on inflation. So here we are in the middle of 2022. And as a forecaster, I'm looking backwards. What were they doing in 2020? And to some extent, 2021. For this year's inflation, I'm not looking at what they're doing this year. So 2-year time lag on inflation, but it's a shorter time lag to affect employment. That's more like a 1-year time lag. So the Fed tightens, a year goes by, there's been very little impact on inflation, but there's been impact on employment. And that's that period we call stagflation. We still got the inflation, but we're starting to get a stagnant economy. And that leads me to a question, and you probably are as qualified to answer this as I am. What happens next summer? Summer of 2023, the Fed has been pushing interest rates up for a year. They see very little progress against inflation, but the job market is weakening. And the Fed has really liked this tight job market. This has been the best labor market ever for a high school dropout with a prison record. You know, no employer goes looking for dropouts with rap sheets, but they've been hiring them because that's all they can find these days. And the Fed likes that. The Fed wants to help the most disadvantaged people. So what do they do summer of 23 when they see a weaker job market? It's tougher for disadvantaged people to get jobs, but they still have high inflation.
So they can't start stimulating then because they risk inflation continuing to go up.
Well, I'd like to be the guy who knows the answer, but I'm about 60-40 on this in my thinking, in predicting what the human beings at the Fed will do. 60% chance that they stick with fighting inflation because there's good reason to do that. And then we're at risk of recession late 23 and on into 24. But there's that 40% risk that they say, oh, we can't keep fighting inflation. We have to worry about the people. And that would take us back into the 1970s, where the Fed would fight inflation for a year and then give up the fight inflation, give up the fight until we had a Paul Volcker.
I feel like just based on, and believe me, you know, the whatever the Fed says, you know, in some way you kind of take it with a grain of salt because they always reserve the right to change their minds. But at least I think in the remarks, I didn't read all of them, but in the remarks yesterday, Powell did mention that he's willing to give up a little bit of the employment situation to fight this inflation.
Yeah.
So I'm leaning more towards your 60% personally, based on those remarks, based on, hey, our priority is inflation. It's not unemployment. We're at 3.5%. We have a little room to allow, you know, unemployment to rise a little bit. And we're really focused on this inflation, you know. So. Yeah,
you know, I if we're just a little bit of a weakening in the labor market, they keep fighting. But what if unemployment goes up a full percentage point? What if we see, and the unemployment rate tends to lag, what we'd see first is layoffs. Initial claims for unemployment insurance would be the variable to watch. And if we start seeing a lot of layoffs, that's when I think it's going to test whether the Fed has backbone.
Yeah. And you mentioned, you said until we got to a Volcker. Do you think the situation could get dire enough so that we have to have the type of interest rate hikes that we had with Volcker, going from like 11 to 17% interest rates?
Right now, we're not there. And if the Fed tightens in this cycle enough to bring inflation down, we do not have to go through a period like 79, 80 and sky high interest rates. But if they waffle in 2023 and inflation accelerates in 24 and 25, at some point, it gets really hard to bring inflation down. It can be done, but it's going to be really hard.
Mm-hmm.
The other thing that's, if I can just roll on here a little bit,
please.
The thing that we economists know really well is that low inflation economies tend to have stable economic growth. And the US experience in the last few decades has been, we go 7 to 10 years between recessions. Mm-hmm. But that wasn't always the case. We had a recession in 70. We had a recession 73 through 75. We had a recession in 80. We had another one in 82. They were coming fast and furious. If we go into a high inflation environment, countries with high inflation tend to have a very cyclical economy, up and down and up and down and up and down. Their average growth rate is about the same, but they do it in fits and starts. and it's very challenging. So that is the biggest reason for me to keep inflation down. And there are people at the Fed who know that. They've done those studies. They've seen the research. The question is, will that reach the decision makers' hearts at the right time?
I gotta, maybe this is a stupid question, but so just kind of going back to your next summer situation, we have an, higher unemployment. Are interest rates the only tool that they have, or like what would happen if they didn't raise rates, but they kind of started buying bonds back and started engaging in quantitative easing?
Yeah.
How would that play? How would all that kind of play together?
Yeah, good question. They actually announced two changes. One was that they would, push up short-term interest rates, and now they are trimming their portfolio, and they're basically going to burn up virtually burning the paper money that they virtually printed in the last year or two. And that is going to be as effective. I'm not quite sure the relative proportions of effectiveness of the two. If they did one and not the other, they would, they might leave short-term interest rates less changed and long-term interest rates more so. Long-term interest rates went up before the Fed's move. Mortgage rates certainly have gone up a good bit since the first of the year. And that is the market anticipating the Fed no longer buying mortgage-backed securities.
Speaking of other tools that the Fed or the government could use, I saw this week Biden's out there demanding that oil companies curb pricing. I wonder what your thoughts are on whether we might see efforts by the government to have price controls or fixed pricing on certain goods and services.
Yeah, could happen. Richard Nixon, a Republican, imposed price controls, and his economic advisor said, this is a stupid idea. And he said, but his political advisor said, that will help you in the next election. And so, he is a representative of all the people. So he did what's best for his own reelection choices. Would, the person in the White House do that? Yeah. I'll let you figure that out.
Yeah.
Price controls, I think, are a remote possibility, but certainly a lot of stupid policy is, a price is not, the discussion in Washington, D.C. treats a price as a transfer mechanism. How much money goes from one person's pocket into another person's pocket. And high prices are evil because it moves money from consumers' pockets into a company's pocket. But we economists tend to see a price as a signal wrapped in an incentive. It's a signal that people would like to have more gasoline. And this happened before the Ukraine war. People started driving more. They were commuting to jobs. They were taking vacations. Factories were running and they needed energy. So the rising prices was a signal, the world needs more energy. If you're using it in a way that's not very important, cut back on your usage. If you have the capability to produce more. And price control or the president jawboning corporations, that takes away the signal, takes away the incentive for us to produce more energy or use less of it.
Yeah, it's certain. We're in real estate, and we know price control in real estate as rent control.
Yeah, sure.
And it certainly interferes with the free market system. And
and does it actually solve the problem of housing availability?
Absolutely
does the
not.
opposite.
That's a supply and demand issue, and it actually, as you were going to say, does the opposite.
Yeah.
Well, that does go into, maybe overall what we've been talking about and how much there's a large argument and conversation around, hey, you can't, adjust interest rates enough to unload ships faster or
Sure.
get these oil, companies to use their existing permits to drill more. spend the money on CapEx to do things. And so mixed into all of this kind of 2024, maybe forecast that you're talking about, would that period of time give the supply chains some time to kind of straighten out? And will that affect inflation without us even knowing it and thinking that interest rates or quantitative easing were the things that solved it, when really there's a big, huge supply problem that we have right now, right?
Yeah, great question, Mark. And, we live in a multi-causal world, and everything has multiple factors affecting it, which makes the study of economics so wonderful. And, I'm even in a calm year, I find wonderfully interesting things to look at. So we had rising inflation before the Ukraine war. The Ukraine war certainly added to oil prices and food prices, no doubt about it. We had congestion at ports. We had companies that couldn't get the raw materials they needed because there was no truck driver to move the stuff there. And that was slowly getting better. More people were going to work as the stimulus checks got farther behind them, as schools became open more reliably. And we were working through some of the supply snarls. But I think that those supply issues were, maybe 20%, 15 or 20% of the total inflationary pressure. Most of it was just too much demand relative to our productive capacity. And the labor shortage was not just about people not working because they were afraid of COVID. It was about a surge in demand for labor by businesses. Businesses were saying, our orders are up, our sales are up, let's hire more people. But you can't have all the businesses hiring more people at the same time once unemployment is low.
Right. That's interesting you say that, because what I noticed just in the last 3 or 4 weeks is, say, a Walmart right now, Target as well, they're complaining that they have too many electronics in their warehouses right now. They actually over-ordered to try to catch up with that demand that was going on a few months ago, especially thinking that most of America wanted new TVs for some reason. And they bought all this stuff, and now it's sitting in their warehouses and nobody's buying anymore right now, at least.
Well, it's always a business challenge to figure out what to produce, what to sell. And we in the macroeconomics area are sort of looking at the aggregates. But the fact is, a real live business has to figure out, do people want big screen TVs, or do they want a vacation? And as COVID has waned in terms of people's behavior, an effect on people's behavior, more people want to fly. I'm amazed every time I book a flight at how expensive it is. And people are traveling more. And they're like, okay, everybody who got a stimulus check and wanted a big screen TV now has a big screen TV. Bicycles are still on back order. Some new cars are still hard to find. So we haven't worked through all of the supply chain challenges, but people are shifting what they're spending money on. They're going out to eat a lot more. Restaurant sales are way up. But you think about the big box home improvement stores, Home Depot and Lowe's, and the big regional chains. People were doing their home improvement projects in the summer of 2020. Lumber prices, plywood prices went through the roof. Well, who's going to do the big project now? They're back at work. They haven't had a stimulus check for over a year. And it's time to go visit the in-laws in Ohio or wherever.
Did I miss something? Because maybe it's the unemployment side of things, but not everybody got unemployment. And that was way back during COVID. And I can see the ongoing unemployment checks and the extensions really kind of, putting money in people's pockets. But the stimulus checks were only $1,400, maybe $2,800 for a family. That's not a lot of money. And people have been talking about, people have gotten these huge checks and now they're all of a sudden rich. $2,800 is not a lot of money by any stretch of the imagination, especially considering rents were increases and things like that. So I'm just wondering, what did I miss here where everybody was getting rich when a lot of people that I know actually weren't?
Yeah.
And like, what am I missing here in terms of all of the stimulus money coming into the economy that people are talking about? That I feel like it's a thing where people, they aren't working, they aren't driving to work, they're not spending as much in gas, they're not spending as much going out to eat, things like that. And that's where they were kind of slowly saving up their liquid cash. But I'd love to hear what you think about that.
Yeah. One of the things that is valuable and took me many years to learn is don't think of people as here is the typical consumer. Think of a wide range of people in different situations. And the vast majority of people got those stimulus checks and put them in the bank and did not spend. Or if they got $1,400, they spent $100, splurged on $100 or $200. And savings really took off in the economy. The total dollars, that people had as income, not spent. So, but some people spent those on their current needs. And there's a small portion of the economy that works when they need money. Mm-hmm. And the decision to show up for a shift today on the job depends on how close you are to making, your rent payment, or, do you have your food there? And so that small portion of the population, they have worked in a lot of the service sector jobs. They've done restaurant in particular, a lot of servers. Talk to a restaurant owner and say, hey, have you ever had a server just not show up? And see what the restaurant owner says. Now, in the kind of office environment jobs, the corporate jobs I've had at corporate headquarters, people call in sick, but nobody just doesn't show because they don't feel like it.
Right. Right. Bill, what types of, just shifting the conversation, so given we may not be in a recession yet, but we may be entering one, what types of assets should people be allocating their funds towards? I mean, certainly I think cash is not the right thing because of inflation. Your money's worth less each year. But what would you say? Stocks, real estate, commodities, gold, other?
Yeah. Well, first of all, my views on the stock market should be used for entertainment purposes only, not for investment. Mm-hmm. I have tried to, predict these things, and I still have opinions. But what I do in my own personal portfolio is I basically decide on a wise asset allocation, and I stick with it. Stocks, real estate. I believe in bonds, but I haven't been able to bring myself to buy a bond in years since interest rates went real low. I'm hoping one day to find some bonds that pay nice interest rates again. But I don't go messing around with that very much. In the pandemic, I decided to drag my feet on reinvesting dividends. So the cash balance went up. The nice thing about cash is it may go down in purchasing power, but if you have $100 in the bank next year, you're not going to have less than $100 in the bank. And real estate has gone down in the past, especially leveraged real estate. The stocks can go down. So I recommend that for me, just easy, good asset allocation, and don't try to time the market. Now, that doesn't mean I don't have a little pot of money to play with. Mm-hmm. It's sort of like, if I go to Vegas, I'll allocate a little bit of money for, roulette, and in investments, allocate a little mad money, for the fun of investing, that's fine. But other than that, I believe in a stable asset allocation.
Yeah, I think it's been proven so many times. It's just so difficult to time the market.
Yeah.
You're better off, as you say, investing for the long haul. And that's where true wealth is built.
And also, I mean, some people are maybe too young to kind of, think about this, but, and maybe I'm wrong in thinking this, but we should always expect recessions. It's cyclical, right?
Yeah.
There's going to be a slowdown there has to be, right?
Yeah.
And, sometimes it's painful and there's some of these black swan events or even crashes or things like that. But for the most part, we should expect a slowdown. And there's for at least from our perspective as an investor, there's opportunity in those periods. But what you talk about, Bill, in terms of, kind of investing for the long term, it really kind of allows you to say, hey, something's going to happen in there. And over the long period, because we have one of the best systems in the world, putting aside monetary policy, in terms of investments and things like that, there is an incline of growth. And if you just take the long term, you find businesses to invest in on the stock side that you have done some of your homework on, and just stop kvetching over all of it, then, and don't use your stock account as your bank account, just let it go and do its thing, and you should be able to ride things out.
Yeah. That leads us to the business side of things. Right. And in business, you're trying to keep an operation going, and you could have sales drop sharply in a recession. Mm-hmm. One of my clients is a title insurance company, and they make money when there's a transaction, including a refinance. So business boomed when mortgage rates fell in 2020 and 2021. 2022, the number of refis is way, way down. Mortgage brokers are laying off people. Title insurance companies have had to lay off people. I think the appraisal industry is maybe softening as well. And planning for that, even if you don't know when it's going to happen, when you're in a boom and you're running a business, you ought to say, okay, what are we going to do when it happens?
Exactly.
Mm-hmm. And even if you're not, if you don't pull the trigger, if you've thought ahead of time about what you will do when things get tough, thinking about it ahead of time enables you to act faster, because you don't have to go through the whole thing. And also it enables you to act smarter because you are executing a plan developed when you were relaxed, a plan developed when you're in a panic. Oh God, can I meet payroll? The bank is on my case, or I'm not meeting Wall Street expectations. Those panic decisions are usually the worst decisions. So I advise everybody do contingency plannings for downside as well as upside.
Yeah, that reminds me of title companies, right? I can imagine the guys or gals that started the title company, and they've worked so hard, and they finally are able to just deal with clients and go out on the golf course most of the time, and, and they have other people doing their title work. Well, now they have to lay people off, and so they have to go back to start, getting back into the weeds with the title stuff, because
exactly.
Times are a little bit tight. So but that's really that is one question. I see that you consult with businesses, and I really love kind of the way your approach to this. And so, can you just talk to us a little bit about how you help businesses, where you kind of come in, like what's your role with consulting with businesses?
There's a wide variety of things. The most common thing I do is talk to people about the economic outlook. I'll brief a board of directors, trade association, speeches and informal discussions. And, I try not to just talk about the economy. I try to say, what does this mean for your business? Mm-hmm. So when we were in the labor shortage, well, even before that, the demographics are such that there will be virtually no growth of the working age population in this decade. Between now and 2030, hardly any, and 2030 to 2040 is going to be very, very slow growth.
Native born or
Both.
With net migration?
Yeah, net immigration, even including estimates of the undocumented, is very low these days. And even with that immigration, very low growth of the working age population. So what do you do about that? And I first started talking about this, the nice thing about demographics is you can see it coming decades in advance, based on births. And corporate leaders were not interested in it because it was going to come too late. It was going to come after their retirement. And they're like, it's the next guy's problem. Well, now it's everybody's problem. And even with the pandemic over, it's going to be a tight labor market. It was a tight labor market in January 2020. Yeah. And so I'm talking to companies and I'm trying to get on their radar screen the big issues. And for a long-term perspective, employee productivity, employee retention, employee recruiting are going to be crucial in that order. Mm-hmm. Productivity. And there are people out there running operations who were not interested in automating to get rid of their employees. They kind of felt a responsibility to their employees. But now they cannot get the employees. So to keep the ones that they currently have working, they need to hire people, but they can't find the people. So these people are saying, I want some freaking robots, and I don't want anybody doing manual data entry. We need computers that do electronic data entry. So there's a big surge of business orders for equipment, computers, robots, machinery. And that's important. And I think it needs to continue. And then employee retention. I got an issue of one of the business magazines that had the best places to work. And they're talking about all these nice benefits. I believe the best benefit an employee can receive is a good boss. You can put up with, you don't have to work at a company that offers goat yoga. If your boss is a good boss, listens to you, encourages you, corrects your mistakes, but also praises your successes. And business in general, I think, does not enough to train their first level managers to be good bosses.
Interesting. Bill, you raise an interesting point about the role of AI and we're actually having over time a decrease in population. And there's always been this fear. There's been this general fear about AI replacing workers and what that's going to do to unemployment. But it's interesting to hear you connect the dots there and say, well, the workforce is actually declining. And so we need AI, and that's not really going to displace, that many people.
We worried that the robots would take jobs. Now we're hoping that the robots will fill the empty seats.
Interesting. That's fascinating. And what role do you think technology and AI has in creating a deflationary environment and technology lowering the cost?
Yeah. All right. Big picture here is inflation is about too much money growth relative to our productive capacity. And Milton Friedman is credited as really bringing monetarism into the forefront of economics. But he said money supply growth relative to growth in productive capacity. And what we had with globalization, the opening up of China and other Asian economies, it was like an increase in the world's productive capacity. And here in the United States, we had access to all this productive capacity that we could buy cheap. And so that meant that we could have low inflation with low money supply growth. And it doesn't actually change inflation if the monetary authority, the central bank, the Federal Reserve, recognizes what's going on. another wave of productivity improvement is like an increase in productive capacity. And it is deflationary if the Fed doesn't do anything on its own. Mm-hmm. But whether it's actually deflationary or inflationary depends entirely on what the Federal Reserve does. But it does make our lives better in the sense that we can get more of the stuff we want with fewer resources.
Mm-hmm. I'm a futurist. It feels to me that we're just not there. We're getting there, obviously, and we're going to get there, but we're just not there yet with AI. It feels very piecemeal, and it feels like the robots that we have, they can sit there and flip a burger, and that might be helpful for something. But in terms of really moving the needle on all of this stuff, it doesn't, maybe in the aggregate, right now it will, but it feels like we're a long way away from really having like robots to do everything that humans can do to kind of fix some of those labor problems.
Yeah, I think you're absolutely right. What I anticipate having is piecemeal, task-specific assistance. Mm-hmm. And you think about the automation in factories. It started out as, hey, let's have a specialized tool to do this job. Mm-hmm. It's not a standard wrench. It's a wrench made for this particular bolt going on that particular thing at this particular torque level. And then after you do that, you had a robot sort of run the wrench. And in an office setting, I think there'll be there'll be assistants, automated assistants. And mm-hmm. I'm at work, and right now, if I need to double check that I've got the unemployment rate correct, I turn to a spreadsheet. Mm-hmm. But why don't I just say, hey Google? Oh, I don't want to say it. I'm going to wake up Google or Siri. I will ask this automated assistant, hey, what was the last number on the unemployment rate? And it'll just pop it out.
Right.
Well, this has been absolutely terrific. It's been a real treat for Mark and I to have you come on the show. So we really appreciate it. If businesses or other people are interested in learning more about your services, how can they get in touch with you?
Yeah, the best way to do it is to ask your favorite search engine to find Bill Conerly. It's spelled with one N, Conerly, but they know me by various misspellings. I've got a website called ConerlyConsulting.com. Take a best guess at your spelling and type in Bill Conerly or Bill Conerly Consulting, and you'll find me. I write regularly for Forbes.com. You can find me there. And if you follow my Twitter feed, you'll see those articles pop up.
That's great. I'm actually going to go there right now and follow you. So
thank you, Bill.
Yeah, thank you so much, Bill. This has been great.
Good chatting with you guys.
All right. Bye.
Take care.
10X for Gen XYZ is hosted by Zach Winter and Mark Adair Rios, co-founders of Prosperity CRE, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and building long-term wealth. If you like the podcast, please give us a positive rating and subscribe to be notified about future content. Also, if you'd like to learn more about our approach to real estate investing, you can download a free copy of our real estate investment book, Investing for Cash Flow and Long-Term Wealth, by clicking the link in the show notes below. Thank you, and stay tuned for our upcoming episodes.